Our guest speaker today, Mr. Eldon Rude, is a professional in the real estate finance industry. He's got about over 30 years of experience, and most of that career has been in analyzing market trends and cycles in the real estate economy. And he's the principal and founder of 360 Real Estate Analytics that compiles research and data to help real estate professionals make the best decisions that they can, and does some consulting in the real estate industry. So we're glad that he's here today, and take it away, Eldon. Thank you.
Super. Thank you, Tibet. Thank you, Amin, for inviting me out this afternoon to chat a little bit about what we see going on in the real estate economy in Central Texas. Most of you are new faces to me, although some of you are familiar and some of you maybe I haven't seen in a while. When I saw Ray when I came in the door, I figured he got lost, but maybe he just came downstairs. Good to see you. So most of you are probably here, at least with respect to me being here today, to kind of get a little more insight in trying to answer the question of where we are in the cycle. What inning are we in? What quarter are we in? I get that question a lot from my customers as well as when I'm out speaking. So I will warn you that one, I'm kind of an optimist, so be careful with that. An example of that, I know we're at Trinity Title, but I have a monthly breakfast with a group of folks that are kind of long-term real estate professionals in Austin, one of those being Bob Roberts with Gracie Title, okay. Doug Kottner with Texas Capital Bank, Steve Martin with Jackson Walker. And every month we get together during football season. Bob always wants to bet on the upcoming UT football game. And his son is actually a walk-on on the team, so he's very excited about that these days. So last year, each game we would make a bet on the score of the game, and the person who's the furthest away from the actual score buys breakfast the next month. And it got a little bit comical as the year went on. The number of points got bigger and bigger and bigger as the team obviously got worse and worse during the year. So we got together a couple weeks ago, and Bob, of course, said, okay, we got the Notre Dame game coming up, so let's do the bets. And everybody kind of does it blindly at first. And, I thought, okay, his son plays for the team, and, he's got to be excited. And so we all submitted our bets, and I guess I'm either too optimistic, foolish, I didn't learn my lesson. I was the only one that picked UT to win the game of the group. So we'll see what happens. I'm doing my best to get rid of Notre Dame players as time goes along. Okay, I think you've been reading. I got 6 off the team, so we'll just see how we do the next week or so. Tibet talked a bit about my history. Let me tell you a little bit more, kind of to help put the context of what I'm going to talk about and what I know about and what I don't know about. So I've been tracking the Austin real estate thing for more than 30 years. I went to school here. Got out of school. I appraised commercial real estate for about 12 years, had my MAI designation, worked for a guy named Rudy Robinson, who some of you probably remember, then worked with some other partners for a number of years. About 20 years ago, I went to work for a company called Metro Study, and Metro Study is a national group that focuses on really land development, land entitlement, acquisition, horizontal development, and home building for sale housing. So my job for 17 years was to work with our builder, developer, lender clients in this region, helping them kind of assess risk of what's going on in the marketplace. They sold about 3.5 years ago to a national company. I elected not to go to work for that company. And after about 9 months of trying not to get sued by the acquiring company, I started my own research practice, 360 Real Estate Analytics, about 3 years ago, this month actually. And so what I have been doing the last 3 years is going back to my builder, developer, and bank clients and reestablishing relationships with them where I meet with them on a regular basis to kind of keep them updated on what I see going on in the marketplace and what I see coming. So my world is primarily focused on land that is acquired, entitled, developed for residential housing. And so that's what I know about mostly, so that's what I'll talk about mostly today. That said, there are a lot of things that influence that whole business. And it all starts with what's going on with the economy. So what I'll do is I'll kind of give you a brief update of what I see happening in the national and regional economy, Texas, and then I'll focus on Austin and talk about housing a little bit, and then obviously talk a little bit about the for sale housing market and go around the map a little bit and talk about some areas that I think might be interesting. And then I'll certainly open it up for questions. And if you guys, actually, as I speak, if you have any questions or comments or want to argue with me, whatever it might be, feel free to you won't be interrupting me, but ask a question. I'll be happy to address that. So, you know, as you guys know, at the beginning and end of the day, the driver for real estate, whether it be commercial or residential, is economic growth and job growth. And we have been in a very strong run in Central Texas for nearly 7 years now since the last recession. The most recent job numbers that came out last week from the Workforce Commission, I think we're at an annual rate of like 37 or 38,000 jobs, new jobs a year in Austin. That's almost 4% growth. That fuels demand for real estate products. With an unemployment rate hovering around 3%, a lot of the professional jobs that get created in our region, people got to move here from somewhere else to take those jobs. And when they move here, they got to live somewhere. And so they're either going to rent an apartment, they're going to rent a house, they're going to buy a resale, they're going to buy a new home. So that's what's been fueling our housing market. One of the kind of indicators I like to look at in terms of the economy and what's going on in terms of job and companies growing is what's happening in the office market. You know, companies leasing new space to house new people. And if you look at the most recent stats for our office market, we had I believe it was a record year. You might go back to the 80s and see such a high number of like 2.5 million square feet of office space absorbed in the last 4 quarters. That's a big number. That's a lot of companies growing, expanding, and planning on growing and adding new people. The industrial market is very strong as well, strong net absorption. So those are really leading indicators of what's going on in terms of businesses growing. About a year and a half ago, our job numbers started to slip a little bit. I mean, we'd been doing about 40,000. The number went down to about 21.8. A lot of us were a little bit concerned that the numbers were slowing because that's what the indicators were showing. Within 6 months, the Workforce Commission revised those numbers back up to like 40,000. So the economic engine remains strong as of most recently, especially with respect to the job growth. Moving over to housing, it's interesting, and I talk a lot about this with my customers, especially my builder customers. This cycle is different than the last couple cycles of 04, 05, 06, 07, and of the 90s in terms of who our renters are and who our buyers are contrasted to some previous cycles. The example I like to use is the technology base in Austin used to be companies that made stuff. So they made computers, they made chips. So think of AMD, Motorola, Samsung, Dell, those kind of companies. The people that came in for those jobs generally were college educated. They were engineers. They got married earlier. They had kids earlier. They moved to suburbia earlier. You know, think of the mountains, Spicewood, all those areas up around Round Rock. So this time it's different. So the people that are moving to Austin, they're taking a lot of the technology jobs, they aren't making stuff. In actuality, the semiconductor manufacturing component or computer manufacturing component of jobs in Austin has been shrinking over the last 7, 8, 9 years. So the young people that are moving here, they design stuff. And I can look around the room and kind of get an age gauge, so I can get away with just saying that they design stuff. And they're different in terms of where they want to live, where they want to work, where they want to play. And so we can see all that when we drive down South of First, South Lamar, South Congress, Miller, Domain, downtown, and see all of the vertical and urban apartments that are accommodating a lot of those young people that are moving to Austin. And so, you know, the demographics don't lie. I mean, they are delaying decisions in terms of marrying and having kids. And so we felt that in terms of our suburban housing markets. So you look at the apartment market. I mean, we're building a lot of apartments. I think we've got 18,000 units under construction. We delivered 3,900 apartments in the second quarter of this year. That's the highest since the 80s. We absorbed 2,900 units in the quarter. That was a big quarter. Occupancy rates are still 94%. Rents keep going up. I think the latest number for average rents, all classes of apartments, this is the new stuff, old stuff, is like $1.35, 36, 37 a foot. The Class A apartments, suburban, a lot of those are in the $1.30s. The urban stuff that you see on South Lamar, South Congress, those units that have structured parking with wrap by stick built are $220, $230, something like that. The vertical stuff downtown is now $3.25, pushing $330 a square foot. So a 1,000 square foot apartment downtown is $3,300. And oh, by the way, if you want another parking place, that's another $150 or $200 if you have a pet, etc. My wife and I have lived up off Shoal Creek for probably 20-something years, and I've been trying to get her to go down and look at some of the urban stuff just for grins, and partly it makes it easier for me to do market research if I have her along. So we went this last weekend, and we went down and we looked at North Shore, and we looked at Bowie, and we looked at Seahome, the condos there. And it was really interesting and eye-opening to kind of see the projects down there and see how expensive they were. And probably I'm kind of getting sidetracked here, but one of the most interesting things I think about some of the urban apartments downtown plays into this reality of younger people that are living there that need less space where they live, but need other space where they can work and play. And an example is in North Shore's project on the amenity floor, there are a number of boardrooms, conference rooms, common areas where if you ran a business, you could run your business out of those rooms and live there. So it's kind of an interesting change in dynamic that is keeping people downtown and allowing them to delay that decision to move to other areas. So it's kind of interesting. So moving over to kind of the for sale housing part of it, we all see the MLS numbers that come out every month, and the articles that come out are generally making a big deal about what happened the last month in terms of activity. I don't like to look at it that way. I like to look at longer term trends in terms of how does that month play into the texture of what's happened in the last year or the previous year. So you look at the numbers overall, and the sales were down, I think, 4% July of 2016 versus 2015, but overall volume is still at a very high rate in terms of overall transactions. And what I look at as kind of the key barometer of the market is the months of supply of inventory. And the reality is that we've had below 4 months of supply for 47 straight months. And equilibrium somewhere between 4 and 6. I get asked that question all the time. So what's equilibrium in terms of months of supply for homes or lots? And the reality is there is none, because you're either going one way or the other. You don't stay in equilibrium very long, but it has been a very tight market in resale for 4 years now. And when you have a month supply that low, prices are going to go up. And so that's what we've been seeing happening in our market the last, 4, 5, 6 years almost. When you break it down by price, and this is going to hold true as I talk about the new home market as well, the price points, say below $325, somewhere in there, have gotten tighter over the last year or two, meaning months supply going down. And then as you move up in price, the months supply have gone a little bit higher. Not out of balance, just a little bit higher, more supply relative to demand. But overall, the numbers are still very good. Looking at the new home market, so this is again kind of where I spend my time. In terms of just sheer production, so how many houses are we building? We peaked out in the last cycle about 18,000 single-family starts in the region. During the recession, we got down to about 6,000, and that was pretty consistent with most of the other Sun Belt markets across the country. We're now back to somewhere around 13,000 single-family starts in the region, so fairly healthy numbers. When you look at total job growth of 35 to 40,000 jobs, we probably should be building more houses than that to accommodate that many people moving here. But the reality is two things. One, people are delaying that decision to move, to buy. And two, it's impossible almost at this point for the developers or builders that develop lots to put on enough lots in the right price ranges to accommodate demand. So then when you kind of break down the new home market by price, it's kind of interesting. So coming out of the recession in 2010, 11, 12, the strength of the market was in the move up. So let's call that 300 to 700,000. And so that's where the builders were focusing. So a lot of that activity was in Cedar Park, Leander, Lakeway, Bee Cave, Dripping, those areas. And this is just the way real estate is. It's a herd mentality. So whatever's hot, that's where everybody's going to go. So the builders migrated to those price ranges. Even some of the production builders that you might think of as kind of first time, including DR, Horton, they brought in their Emerald line here, and Lennar brought in Village. And then the development community got very busy and active, bringing on lots, a lot of lots in Bee Cave, Lakeway, Dripping, up 29, Leander, those areas. And then a funny thing happened probably 18 months ago as the market kind of began to shift in terms of more focus on the first-time price ranges. And so over the last couple of years, or the last year or so, that's where the heat of the market has been. And so now all the builders are racing to get down in price to meet all the demand below 350 or so. And that leaves us in a situation where some of the submarkets, especially further northwest and out near Lakeway and Bee Cave and in Dripping, we've got a few too many lots relative to demand. So more communities, more builders, more competition. So it's a little bit more competitive in some of those areas. Whereas if you go out to Kyle, especially east of 35, Manor, Hutto, East Pflugerville, I mean, we're building more houses in those areas than we have probably in 8 or 9 years. The builders are extremely busy in those submarkets. So it's kind of an interesting change over the last year or so. I know that you guys focus some on the urban housing thing, and last quarter I did kind of analysis of some core zip codes, looking at 02, which is pure East Austin, 03, which is obviously kind of central, and then 04, which is obviously Travis Heights, Bolden, and those areas. And a lot of activity done in those areas. I mean, the builders have been very successful down there the last 3 or 4 years. What was most interesting to me as I looked at those markets, those 3 zip codes, was right about the time that we went from 20,000 jobs to 40,000 jobs a year in Austin, so right around 2012, the level of appreciation in those zip codes just took off. I mean, I think in 04, if I get this right, it's been since, I guess, about 6.5 years, or maybe the last 5 years, like 80% appreciation in home prices in that zip code. Now, part of that is people buying lots, tearing them down, building a house, and selling at a higher price. And then the average price, I think, of the specs over there is like $1 million in that zip code. So it's pretty amazing what we've seen over the last 5 or 6 years. But if you look at the pure numbers in terms of the number of homes that we have sold new in those 3 zip codes relative to what's available now, either finished or under construction that's new, you know, the months of supply is really in pretty good shape. I mean, it's going to be a little higher than in lower price ranges, but it looks pretty good. That said, and I know you guys have some stuff in 04, if I looked at any of the zip codes, 04 would be the one that I'd probably be more careful in, just because there's easier entry there, there's more liberal zoning down there, a little fewer barriers to entry there, and the builders are beginning to get a little bit creative, if you will, in terms of what they're doing down there. I was at a meeting at the HPA, the Builder Association, a few weeks ago, and it was all infill builders. And it came up that in some of those zip codes, and that one in particular, that to make the numbers work now, in some cases you're having to do duplex instead of single family on that one lot to make the numbers work. So, you know, again, I think if we continue to have the type of economic activity we've had the last several years, I mean, we can't build enough houses to satisfy demand. So that begs the question that I kind of posed in the beginning. So where are we? You know, where are we in the cycle? I hear everything from we're still in the 5th inning, to it's the 7th inning, to it's the bottom of the 9th, to it's extra innings. So, you know, reality is none of us know. But a couple things that we do know. So one, we're deep into this cycle. So we're 7 years into a very strong economic cycle in Austin. Two, we know that our economy, while having state government and UT is a big deal, the growth that we've experienced this cycle, a lot of it's tied to technology. I mean, so technology companies growing, expanding, bringing people here that are high paid, and those jobs create other jobs. So they create secondary jobs of school teachers and nurses and doctors, et cetera, and restaurants or whatever. So I think a good example for us to kind of help answer the question of where we are is to look at Houston. So Houston was humming along at 120 to 150,000 jobs a year until July of 14, when the price of oil went from 90 to wherever it is now, 30 or 40 bucks. And companies there started laying off people, professionals. So Houston's job growth now, I think the numbers that came out last week for the last year were 13,000 jobs in the previous year, down from 120 or 30. More importantly, if you look at the composition of those jobs, professional business service jobs in Houston, and those are high-paying jobs, they're actually losing jobs. So those numbers have gone negative, and they're the jobs that create other jobs. That said, the housing market in Houston has remained fairly resilient over the last couple of years. Their luxury market, their move-up market have certainly gotten hit to a certain extent, but their entry level and kind of first move up, those numbers are still pretty strong. So we're 2 years plus into an economic downturn in Houston, and I'm not sure when it's going to recover. I'm not an oil and gas person. And yet the housing market is still doing okay. Now, not urban apartments and not some of those, but their for-sale housing market, especially the first time. So you contrast that with Austin. So we haven't had a blip yet in our job numbers. We're still at 35 to 40,000 jobs. All our markets are tight in terms of housing. So it's hard for me to look at our numbers compared to Houston and say, okay, you know, we're in extra innings, or we're about done, or this is about over, when we haven't seen a dip in our job numbers. Now, when that happens, we're all going to know about it. We're all going to read about it, because at some point the tech economy is going to experience some kind of correction. It's probably not going to start here. It's probably going to start in Silicon Valley or Boston or some of those areas. But we'll know. And that will be the time, I think, where we begin to take pause and look closer at what's going on in terms of the job market, office leasing, industrial leasing, how many people are moving in, taking in new apartments. But at this point, you know, I don't see any of those things. You know, will it happen? Absolutely. Ray, you've been here for a few of these. We've all been here for a few of these, most of us. You know, this has been a great run, and it will continue to be until such time that we begin to see those economic indicators that begin to change. So, you know, I'm optimistic. I'm still betting on UT. We'll see how that turns out. I don't know. It's got to turn sometime. Anyway, I'll open it up for questions now. If anybody has a question, I'd be happy to try to take a stab at it. Sure.
Eldon, how do you see, I mean, last time we saw where lending practices changed the landscape, how does that factor into some of the work you do?
Yeah, good question. So certainly from the standpoint that, I'll talk about two components. So certainly from the standpoint of a prospective home buyer going in to purchase a home from D.R. Horton or Cal Atlantic or whoever it might be, that criteria is different than it was in 04 and 05 and 06. So that person that could get that loan that didn't have a job, that didn't, you know, whatever, you know, they have to have some proof of income. You guys know more about this than I do. So has it gotten easier? Absolutely. Is there still zero down out there? Absolutely. But that criteria helps, if you will, in terms of stability of the marketplace. On the commercial side, in terms of borrowing money for either acquisition or development of horizontal, I'm not going to talk as much about the commercial market because I don't know as much about it. You know, the equity requirement is there. I mean, those guys, whoever's doing that are generally going to have 50% or 60% equity coming in. And the credit folks at the commercial banks are a little more diligent probably this cycle because of some of the Dodd-Frank, et cetera, realities they have to deal with in terms of their buckets being too full of commercial real estate. So, you know, if you have a collapse in the market, it doesn't matter in terms of equity because, you know, there are going to be issues there. but there's more protection this cycle than there certainly was last cycle, especially for that core person who's buying a home. So that's good for us in the long term, I think. So, anybody else? Sure.
Any analytic thoughts on, say, north of Austin, Round Rock, Georgetown area?
So, the last few years I've done a lot of work up Ronald Reagan, 29, in those areas because there's so much going on up there in terms of acquisition, entitlement, and development. So what is great about that area, one, you can look historically at how many new homes we've been building as a share of Austin, moving up kind of that Round Rock over to 183 area, and it's a big percentage. And the reason is that, first, school districts. So Georgetown schools, Leander schools, Round Rock schools, now Liberty Hill schools, they're all good school districts. And so that will drive families to live in those areas. Two, roadway infrastructure. So Williamson County, unlike those of us in Travis County, believe in building roads and accommodating future traffic issues. And you've got that going on up there, and you don't have that as much. So, and you get west of 35 especially, and the land is prettier than east. There'll always be that component east because that's about affordability, if you will. But I don't see us, except maybe some price point issues because it's gotten so expensive for the land to build housing up there below 300 or so. There probably will be some reset up there in the next cycle just because some folks probably paid too much for their land. But we'll see growth up there for a long time. I think. So, did I answer your question? You probably have a more specific one at a certain address.
I don't want the rest of these guys to know.
Okay, all right. Let's make sure you look at that floodplain map, okay? Yeah, okay.
So in the development around the Austin area, have you noticed that the zoning ordinances in the municipalities are adapting to the new demographics in terms of housing density and the types of housing that are going up, or do you have to push that to make that change?
So full disclosure, I live in the city of Austin. I pay city of Austin taxes. I vote in city of Austin elections. I have for 25 years, so I feel totally prepared and able to bash whoever with the city of Austin. So I was an audience member yesterday in an Urban Land Institute event that talked about density and kind of some of the challenges associated with that. And one of the young ladies on board has several projects in Austin. So I think from a conceptual, philosophical point of view, that the municipalities, in particular Austin, has done a decent job of saying we've got to have more density to create an environment to accommodate more people, less taxing on infrastructure, and more affordable. Okay? But then beyond that, from the standpoint of actually approving things, no better. And then just as bad, and this is the reality, we all live in neighborhoods, is that the neighborhoods don't want it. So you talk about Burnett and Lamar and all those areas, the neighborhoods are vehemently opposing anything, I shouldn't say anything, but most things that play into density. And so it's that NIMBY thing, and we all, well, I don't want to say we all, but a lot of people can be guilty of that when it comes to their neighborhood. So it makes it very problematic. This Code Next thing, I think from a philosophical standpoint, is got some great positions, if you will, but obviously there's been a rocky road there because the guy that was leading it left and some other people have fallen by the wayside and they're way behind. But instituting it's going to be the tough part. And it's tough to catch up when you're growing at 3%. It's very difficult. Anybody else? Sure.
I'm curious to hear your point of view on like how much land is actually available. Like if you think about some of our suburbs, like Cedar Park, it seems like it's already totally developed. Like there's really not much land left. What is your perception on that? Where do you see there's actually still land to develop?
So a couple things. One, you can get out your satellite images and kind of see from the standpoint of where is vacant land that's available for development that's not quarry or not environmental. And so, those areas are going to grow and become more apparent as you move out from Austin. Unlike some other supply-constrained cities, that, especially coastal areas, I mean, we have a lot of room over many number of years to grow and accommodate more development and people in the region. That said, some of the municipalities, as you talked about, have kind of looked at their map and tax base and said, we don't want any more of this. And so Cedar Park is saying, you know, we will accept luxury housing, but we don't want any more density. So part of it is governmental and political in terms of what can be developed. And then I think in Austin, you have some of the same issues, and the land just gotten so expensive to do various uses. I mean, that is one of the reasons that we're seeing Riverside Drive becoming a kind of new corridor of complete turnover of uses, and because it is relatively, I mean, it was $20 a foot there 3 years ago, then it was $30, now it's $70, I think, and when Oracle announced. But you'll begin to see reuse like that, like Domain and like the old IBM campus on Burnett Road. So it'll be reused, but very expensive. But that won't accommodate affordable housing for somebody that can only afford a $200,000 house. I mean, it's just, it can't because it's so expensive.
All right, we'll take one more question and then we'll...
Well, that's the funnest part. Golly.
Yeah.
Trying to keep us on schedule. Okay, that's fine. Sure. Yeah.
Speaking of constraints in the northern suburbs, you're not their ability to grow is not limited by our horrible transportation problem. I-35 and 183 and all those commuters and logging up the highways all the time and not being able to get anywhere.
So I mean, there's no doubt that issue has become much more protracted this cycle than the previous cycles because of how intense the growth has been the last number of years. But I don't think it's going to stop it. I mean, there's too much energy, whether this cycle or the next cycle, and interest in this region, and it's just going to be expensive and take creative thinking to get those roads built. So we're going to see more toll roads. We haven't had an increase in the gas tax, since 1980 something. I mean, so you got to pay to drive. So I don't think that's going to really limit it. What will limit it more is political than anything.
There's a lot of room to drive on 130, but nobody's driving it.
Well, I would argue a little bit with that. I mean, this cycle, again, if you're at 290 and 130 in Maine or at 5 o'clock, if you're at State Highway 45 and 130 or in the morning or 5 o'clock, in those east-west connection points, you're beginning to see a lot more. And then I think it's 71 west or east and 130, HEB's about to announce there. So, I mean, there are going to be some things that kind of change that dynamic along 130. I mean, it's finally time. I mean, we built it 10 years too early. We built it too far east. But where you see those major east-west connections at 130, there'll begin to be more and more going on. And that's where we can build housing that's less expensive. Well, good. Well, thank you for your time. Always fun. I appreciate it. And if I can, answer any other questions you guys have, send me an email, text me, throw a fireball or whatever it might be. So I'll be happy to try to help. So thank you, guys.
Thank you.